tax is such an important part of crypto, and yet it's left neglected by many people because it just seems like too much work, all right? Raise your hand right now if you're someone who thinks about tax and you think about a suit and a tie and you just think about tax, man, and way too much stuff that's not to worry about right now, okay? What we're trying to focus on is making money in crypto. Well, funnily enough, a part of you making money in this industry is factoring in tax. If you don't factor in tax, unfortunately, you're going to get to the end of the cycle where you're in a position you owe 25, 30, 45% of all your gains in tax, which means you can say goodbye to the nice house, the nice car, the vacation, whatever it may be. So yes, this is going to be a very important video, but I want to disclose right off the rip, no, this isn't the be all and end all. This is going to teach you a lot about tax and how it works in crypto, but what it's not going to do is substitute what you should go ahead and talk to a financial advisor or your accountant about. Those guys do this professionally. This isn't financial advice. This is just how it kind of works based on my own interpretations. So first of all, when are you taxed? Okay, so in crypto, you're taxed on every single time you move an asset into another asset. Now, this includes stable coins. People think stable coins are a derivative of a real currency, right? Like the US dollar, Australian dollar, even gold, for example. But no, it is a token, and therefore, because it is a token on the blockchain, it is represented as an asset, okay? So as soon as you move, say, Bitcoin into USDT, USDC, or any other US derivative or any other derivative, you are instantly paying tax on that swap. So any gains or losses you've made on that Bitcoin, you are going to be accruing that for tax, okay? You can also, again, do this when you sell on the open market, even if you sell Bitcoin or whatever into actual fiat currency, which you can do in some cases. That also constitutes as a taxable event. When you're swapping around currencies, of course, that doesn't. So USDC to like an Australian derivative, right, whatever that might be, that doesn't really, it's not going to land you any sort of taxable event because it's just stable coin, it's stable currencies. Again, whether you make any sort of gains on that trade or any losses, that will then be added to your tax system. Now, a taxable gain is, of course, when you've made any amount of money. Now, there is a nuanced detail where I'll kind of take most of the conversation today, and that's around something called capital gains tax. So capital gains tax can really be any time you've made a certain gain on an asset, but we're going to look towards not the term itself, because again, it just represents you making money in general, but we're going to switch it to how to avoid paying extra tax, because capital gains tax in of itself can bring on more tax. And that might sound a bit crazy and weird right now, but I'll break it down in a second because this is the real secret killer. Additionally, if you actually make a swap, a sell, whatever it may be, and you've made a loss on that, let's say you bought Bitcoin at $60,000, it drops down to $58,000, you get scared and you swap that or sell that into USDT, you've made a loss, right? You made a capital loss, which means that that's, however much money you've lost there, let's say you put in, $10,000 and you lost, let's say 20%, and now it's $8,000 on that sell. That $2,000 can actually be deductible on the lump sum you've made at the end of the year. So if at the end of the year you make $10,000 over all your trades, that $2,000 can be taken off the top. Therefore, you only pay tax on $8,000. So yes, while it's not advantageous to lose money in crypto, just know there are some circumstances where you can rebalance your portfolio per se and take a slight loss. I think around 5% on a single position is manageable for most. That's a whole different story. And then you can take that 5% loss and again, kind of like claw back some of those potential gains you would have made on other assets at the end of the year as well. So hold on to that capital gains tax theory I mentioned to you moments ago. It's not really a theory, it's a practice, but I'll talk more about it momentarily. But before we do, you've got to understand, first of all, your local, government's regulations or tax bracket system, basically, because this is what you need to understand when you're dealing with your own portfolio. Every single government, as far as I'm aware, around the world has some sort of tax bracket system. Somewhere like where I'm at right now, the UAE or Dubai particularly, doesn't even have tax at all, doesn't have income tax. So this doesn't apply. What you're looking at here does not apply, but there are, again, some countries around the world. I'm going to show you in the case of Australia, the US, and the UK here in a second, but I'm obviously most familiar with my local government's tax bracket system, which is, of course, Australia. And coincidentally, I believe it's one of the easiest to talk about, which is where we'll start here. But nevertheless, this is important because if you're someone making $10,000, let's just say this year on your crypto gains, you're not going to be paying a lot of money on tax in general, okay? It's different if you're someone who's looking to profit, a substantial amount, maybe over 200K, and that could range up to like millions of dollars. You're going to be paying a lot. So this is what I sort of mean here. It works on a bracket system. We find some of this happening in, the financial world, particularly banks like to employ this sometimes, where you're not instantly added to a certain tier. So let's just say hypothetically, I make $180,000 this financial year overall. This includes my crypto portfolio. This includes my real estate gains on my passive income from my property. This includes any dividends I've made. This includes every single thing that I make this year at a profit, and it's added to this. And let's say it comes to $180,000. Well, I'm actually added into this third tax bracket system here, but every single dollar up to $18,200, so from 0 to $18,200, I actually pay 0.1. That's safeguarded. And then from $18,201 to $45,000, that particular lot of cash, that is then taxed at 19% for every single dollar, so 19 cents. I'm being taxed overall there. And then from the $45,001 to $120,000, I am taxed at 32.5 cents for every single dollar, or 32.5%, if that makes sense. And I like Australia because they actually work this out for you in terms of dollars, because it is fixed, right? You definitely know you're not going to be charged at all. If you make $18,199 overall this entire year, you're not going to be taxed a single cent. If you make $1 over that, then that one single dollar is going to be taxed at that next tax bracket, which means you'll pay 19 cents tax, and then so on. So notice at the very, very top over here, I think a lot of us are planning to make probably above $180,000, right? If you're starting off quite small, yes, it can be a bit hard to do that. Maybe you're looking for down here, which is fine. Your tax is very easy. You know for a fact, again, this does consider your other assets that you make or other profitable investments you make in your whole entire year and other endeavors is also added here. But let's just say, you overall think you'll roughly speaking in Australia make about $119,000. Well, then you pretty well know roughly speaking how much tax you're going to pay. It's right there. Okay, nice and simple. But again, anything over this last tax bracket here, and this is the case in most countries, they have a ceiling, right? So if you make anything over $180,000, that includes $180,001, you're taxed at 45 cents for every single dollar. So every single dollar you make, almost half goes away to the tax man straight away. Alrighty? That's crazy when you think about it, right? So I'm planning to make a few $1 million. So when you think about that, I mean, you're talking about half your profits gained. So this is why it's very important to consider tax. Because like I recently showed on my exit calculator sheet, I mean, if you're looking to make $1 million, and I'll show you an example here in a minute, right? And you're not factoring in that additional tax, you have to pay the tax man. Well, what happens? You get the $1 million, let's say you make, and then you have to give a certain amount of that away. And all of a sudden, there goes all your hopes and dreams of what you wanted to do. Maybe that could mean exactly saving up $500,000 to exactly buy a brand new house. And because of that tax system, you've missed out. Therefore, you have to postpone that to the next cycle or whatever it may have been, okay? So it's very important you pay attention to this. Now, the US bracket system is probably one of the more complex. There are nuanced details to where you might sit. So it's worth, again, sitting down with an accountant. For even someone in Australia, like, don't take my word for it. This is an introductory course. So you want to, of course, in this case, assess where you currently sit. Again, they break it up into different sort of types of situations, right? If you're a single entity, married or filing jointly, married, filing separately, or head of a household, it's different. You notice that they break it up a little bit differently as well. So the 10% is immediately added from the get-go. Again, this can deviate and change. You can see how it changes a lot. Of course, married, in this case, filing jointly is the best because, of course, you just double up on this single bracket. So it makes the most amount of sense. You're basically filing singly. Of course, there might be some additional benefits along the way. Head of a household, of course, 0 to that first, 10% here, 15,700 is sort of the highest amount, which is obviously beneficial. You want to pay as little tax as possible on the lump sum you get at the end of the year, at least if it was calculated that way, okay? And then right at the very bottom, you can see here, 37% on, and then those different levels, right? So 578,000 or more, 693,000 or more, and so on. Okay, so again, they always have that threshold, but along this whole journey, if you actually made let's say $578,126 as a single person in the US, you would be paying all of this. So you'd have to work out the calculations for each and every single tier along that, money you've made. And then anything you make above this is then added to the top. Okay, again, you're not just thrown into the lump sum just because you make this much money. You're not thrown into this top bracket instantly, therefore paying a lot more tax than what you'd like to, okay? So while there's a lot of tax being paid, it's not as scary as what you might initially perceive it to be. And sort of more similar to Australia, we have the UK as well. These guys have something called the personal allowance, which is a little bit different, okay? As far as I understand, you cannot qualify for the personal allowance basically, okay, under some conditions, but I think most people will have a personal allowance. Again, this is void, particularly if you make a certain amount of money, so £125,000 or more, okay, you're going to be losing that up to £12,570 for 0% tax rate, so no tax paid on that, okay? So, of course, they're going to tax you more if you're pretty good at what you do, okay? That's how these bloody governments work, right? If you make the money, they want more of it, okay? It's very simple. So this is sort of your tax system over here. Again, this might be one of the worst, I think, out of all of these combined. I think the US is pretty reasonable. I mean, you're not really getting any sort of personal allowance as far as I understand, or again, Australia having that like zero at the start. But it's tiered over a longer level. But the UK, they only have what's really, if you make over £125,000, really only 3 main tiers that you can be smashed quite hard if you're over there. But again, this isn't going into the nuanced details. So I'm likely missing some contingencies here, especially that might apply to you. I'm not saying I'm an accountant. I'm not saying I'm a professional tax man at all. Matter of fact, I'm the complete opposite. I hate the tax man. So in this case, please go and see someone about this. But at least you understand that when you make money in a year, any money or income at all, it's added to a bracket system. And then from there, it's worked out in a tiered way, okay? So what about capital gains tax? This is the big heavy hitter. Now, I'm only going to speak on behalf of Australia. I know that the UK and US have somewhat similar rules and regulations about what constitutes as capital gains tax, in the sense of paying more tax essentially on selling an asset within a period of time. I think the US taxes you entirely on everything, no matter what, whether you hold the asset over 12 months or more, which is kind of the contingency here. And the UK probably is more so similar to Australia. But again, please go and see someone about this. Nevertheless, what capital gains tax really is, and when you hear me say this in videos, is when you sell an asset, let's stick to cryptocurrency, right? If you buy an asset today and you sell that asset in exactly 12 months and 1 day, so 366 days, you're only taxed on half. So it safeguards you basically holding an asset for 12 months or more on half of the profit you've made, not overall, just the profit. So if you invest $100,000 and you make $1.1 million, you're only taxed on $1 million, not the whole 1.1 million. And then again, half that is safeguarded. So you cannot be taxed on that at all. It's safe. It's in your pocket, guaranteed. And then the other 50% of that income, that $500,000 profit that you've made, that then gets added to the tax bracket system we saw before, okay? So then even saying that, right, you're probably getting, it depends on where you sit in that tax bracket system, but let's say you make about $180,000 that entire year on other income streams, your job, dividends, whatever, and then you get added to that top bracket system, well, then that's, $500,000 is then taxed at 45%, okay? So you're not even getting taxed on half of the half, if that makes sense. I know it's kind of complicated, so let me take it through an example here to really show you what that actually looks like. So person A, again, sells their Bitcoin within 12 months of their purchase, so they actually got hit with capital gains tax. So they invest $100,000, their revenue is 1.1 million, so they 11x overall, their profit is $1 million, okay? Now, what happens if we kind of factor in the tax bracket system and work our magic out is because they sold within that, they're taxed on the entire amount. Okay, so that $1 million profit they made minus, of course, we're not including their existing tax they had to pay before, okay? We get $948,000, and then, of course, we multiply that by 45% because they're in the highest tax bracket. Again, we're making some assumptions here, but this is the worst case. They take home $522,000. So in the case that you sell within 12 months after you purchase a project or an investment, anything, right? If you sell within 12 months, at least in Australia, you are getting absolutely robbed from your money, okay? It's a massive difference. This person's almost lost half of their entire fortune or their gains just from that. Now, person B over here sells after that 12 months, even one day after, okay? So they aren't hit with capital gains tax. In the same situation, their profit is $1 million. Again, we run through the tax bracket system in this case. We pull through the different tiers. We minus the existing tax they've paid already, as you can see over here. This is why I like Australia so much. It's very simple to look at. And then we run through the situation of the math behind this, and then they take home $735,000. So they saved, on top of person A, $213,000, which is a lot of money by just simply holding for a few extra days. Big, big, big difference. So just hold on one moment, because I'll show you some situations on dates on when you kind of really need to have some of your positions in to avoid that happening. But I will say one thing, guys. There is a way we can kind of get around this, right? I've broken up my portfolio into two different areas, big bags and small bags. Again, you want to be subscribed down below because I talk about this all the time. Big bags are your main positions, the one that you can't afford to be paying capital gains tax, right? If you put $30,000 into a project and you want to 15x that, okay, so make some pretty damn big multiples, you don't want to have capital gains tax on that. That's your big bags. Your small bags are your positions where you can have maybe a few $1,000s where you might want to buy coins and, trade a little bit, or I guess swing trade and I guess take advantage of some liquidity pools and things like that. You can afford to do that with your small bags because ultimately speaking, it's one, going to be easier for you to possibly track. At the end of the day, you're able to take out guaranteed, okay, I'm entering this position with the assumption of taking it out within 12 months. I know that for a fact. And so then you can take out any sort of gains and pull aside maybe 45% at worst case for the tax man, because he will ask for that money sooner or later. And again, then you can maybe compound some of those actual profits you've made into your main bags. So on and so forth, okay? You splitting those two up is important. And the way you kind of do that now is just by having some cash on the side strictly for, those small bags. Pen and paper, guys, pen and paper. Write this stuff down. I use pen and paper for everything. I know, dollar signs, how much money of my USDT I have to be able to do that in the market at any given time. Okay, so play around with those small bags. Now, I don't know about your situation, but for me, I've got a workaround for all this, okay? I've got a way in which I can afford to buy and sell assets and be fit at a fixed rate. So it, affords me the flexibility of chopping and changing, buying and selling without worrying about being, adding that majority of my profits to that tax bracket, which is setting up a business structure. Now, this is, of course, only speaking from Australia. I know the US has certain accounts and different businesses that gets their way into the same model, but I'm not going to talk about that because I don't know about it. What I've done with my own business is very simply here. Again, this is not financial advice. I created a trust. The trust doesn't deal with tax at all. The trust just distributes income. And then I have a company underneath the trust in which the trust can then send money to the company and or pay me out as someone who basically maintains the trust. So I can, when money comes into the trust via an account I've created with an exchange I'll tell you about in a minute here, I can afford to pay myself out, which will be added to my own individual tax bracket, which is not ideal, okay? Or I can push it to the company, the business, which then has a fixed tax rate, which is 25%, no matter if it's bought and sold in a day or two, or whether it's held over 3, 5, 20 years. It doesn't matter, it's always 25%. Okay, so obviously I'm pushing everything to the company. I, of course, am the owner of the company, and then that's a whole different system in that sense. So that is a sort of way in which you might want to go to your accountant if you are someone in Australia, maybe the UK, maybe even the US has a similar system, and just ask these questions to them. Look, guys, the only way you're going to ever find these things out is if you ask the dumb questions, all right? Make yourself sound dumb, but absorb all that information on board. That's what I did, and I'm very happy with my current position. The exchange I use is actually a brokerage, and it's called Caleb and Brown. I'm not too sure if the link will be down below just yet, but we are partnered with them, and we're partnered with them because I actually use them, okay? Everything is set up through the trust and the business. Everything is all done via those guys with a very seamless process. Again, you can possibly find the link down below if we have it. If not, that'll be there in the next few days, hopefully. And you can go down there and, sign up and then create that account with the accountant or that business structure. And then hopefully, you can, have that reduced tax rate, hopefully. So when should you stop buying your main bags to avoid, paying capital gains tax? Well, evidently paying tax is inevitable, okay? But we're just trying to reduce the amount we pay. So in this case, the best thing I would say is following this sort of plan, all right? Now, in my opinion, okay, the crypto market could end in any day. Like, no one really knows what could cause it, but the market definitely could crash at any moment. It is crypto after all. So what we're trying to do here is speculate on when the market will end to have an idea of when our main bags should be filled. So, okay, if we buy any more past this rough speaking date here, we are risking paying capital gains tax on that additional money. Okay, just because you buy tokens after a certain time and add it to the big pot that you've been holding for 3 years or 2 years or 12 months doesn't mean the whole bunch of those tokens are then going to be hit with capital gains tax. If you buy 10 tokens and that's within 12 months and you sell within 12 months, only those 10 tokens will be hit with capital gains tax. Any of the previous tokens will not be, okay? In this case, I've done the math on this many videos ago, right, many months, like 6 or 12 months ago, I feel like. And basically October 30th, 2025 came to be the rough end of the bull run based on a whole bunch of information. This is only some of it, okay? Roughly speaking, how the bull run has started, ended, from the top, from the bottom, from the top, from the halving to the top, like all that sort of stuff is being looked at in this case. And this was the date that came out of it, okay? So 12 months from this, obviously, is October this year, 2024. And then if we pull back 3 or 4 months from there, we get 2 different dates, the 15 months before and 16 months before, which is July and June of this year. So what I've done there is provide some buffer, 3 to 4 months of buffer to say, hey, we have 12 months from roughly speaking the end of the bull run, right? Plus the buffer to get our main bags sorted. So I would say if you're buying anything within June, July of this year, like again, after these dates, you're possibly risking being hit with capital gains tax, which obviously isn't ideal, right? Now, in saying that, since I've made this chart, there is a few other circumstances that might play out, right? We have the lengthening cycle theory, left translated cycle. I mean, many different cycle theories that might indicate the bull run could end sooner than expected. I think worst, earliest case, December of this year, 2024, could conclude the bull run, which would mean that giving you some time, okay, again, August, September of last year would have been that buffer room. But again, talking about an exact date here, or December of last year, so a few months ago would have been like that tipping point. But I think best case, like probably the latest the bull run will conclude, would be about October 2025. So again, June, July to be safe this year, and October this year, if you were trying to time it exactly, if you were psycho, would be the time to look at, okay? But remember, the market doesn't just all move up at once. The market does not just all have a great sell opportunity here. Altcoins will peak over here, some will peak over here, and some will peak even after October in that case. So you must understand that earlier you buy, the better. You're not going to risk paying that. Again, it's a silent killer. Like, trust me right now, some of you guys will be not worrying about this. I was told in the last cycle, guys paying in the 7 figures, right, millions of dollars worth of tax because they didn't factor in capital gains tax. So look, thank you all for watching this video. I know tax isn't fun. It's not sexy. It's not the hottest altcoin of the week. But what it's going to do is probably save you a hell of a lot of money, more than you'd probably expect, right? So what I want you to do here is help a brother out, help a sister out, help a friend out, whatever, and go ahead and send this to someone who you think needs to know this, especially if they're a high roller, if they're dealing with a lot of money, because it's even worse for those guys. Thank you all. Talk to you soon. Take care. Bye.